Hi everyone, and welcome to the PayFit End of Tax Year and Payroll Changes webinar. I'm Nicola and I work as a Product Legal Advisor, and I'll be hosting the webinar today. Just before we start, I want to say thank you for taking the time to attend our webinar in what is a really stressful time. Payrollers at this time of year tend to want to be at their desks with their heads down, preparing for the tax year end and the April 2020 changes. But safety and well-being are really important at the moment, not just for your own well-being, but to make sure that employees are paid on time and correctly. Now, the government have urged people to work from home where possible, so we've shared some employer guidelines on our blog, and we also keep this up to date with all changes on the SSP legislation as a result of the coronavirus outbreak. And we'll be happy to answer any questions you have or share these links with you afterwards. So today we're going to be looking at end of year tasks, start of year tasks, and we'll be going to looking at some of the April 2020 legislation changes. Now, before we look at the April 2020 legislation changes, I just want to give a quick update for those who may not already know, but it has been announced that the IR35 or the intermediary regulations will be delayed by 12 months. So rather than commencing on the 6th of April 2020, they are now going to be going ahead on the 6th of April 2021. We do have a section in this webinar that covers the intermediary regulations, and we'll still talk about it briefly because remember, this is going to be a delay in the legislation starting as opposed to the legislation being cancelled. So firstly, I'd like to give you an overview of who PayFit are and what we do. So we are a payroll software provider, and we launched in 2015 in France, which is home to one of the most complex payrolls in the world. From there, we've expanded into Spain, Germany, and then the UK. We have 4,000 customers who use us across Europe, including the likes of Revolut, Railsbank, and Flux in the UK. So what do we do? Here at PayFit, we want to enable all employers, no matter how much knowledge they have about payroll, to take control of their own payroll processes. And we do this by giving them a software that allows them to manage their payroll and make their own payroll changes. But we couple this with the support of customer success teams and internal payroll specialists who are always on hand to provide system and payroll support. Now let's take a look at what the end of tax year means for you as employers. So the end of the tax year is officially the 5th of April 2020, but there are tasks that fall either side of this date that you're going to have to complete to make sure that you're fulfilling your HMRC expected duties. So we're going to just take a quick look at each of these steps and see what that means for the end of the tax year. So the first one is the full payment submission, or the FPS. Now, the full payment submission is a detailed submission that is sent to the HMRC no later than payday, and this will include no later than your March payday, and it's details of each employee, including their personal information such as their name, but also their tax, national insurance and earnings information. So there are very few changes to the final FPS that you submit. However, in the final FPS that you submit for this tax year, you will need to use the indicator within your payroll or your RTI software, if you use a separate RTI software, to indicate to the HMRC that this will be your last submission of the tax year. This just lets the HMRC know that they don't have to expect any more year-to-date information from you for your employees. Next is the final EPS, or the employer payment summary, and this is due by the 19th of April. Now, some of you may not submit an EPS, you may not need to. An EPS is only submitted by those employers who reclaim amounts for the likes of statutory pay, such as maternity, paternity and adoption. You may also submit an EPS if you are liable to pay the apprenticeship levy, or if you suffer deductions under the construction industry scheme. Just a quick note on the EPS. If you do forget when submitting your FPS to indicate that it is your final submission of the tax year, you can use an EPS to do this too. Next, we move on to P60s. Now, P60s are a document that you must give to your employees by the 31st of May. Remember, this is an employee-only submission and this isn't something that's issued to the HMRC. This document contains details of their year-to-date earnings information, and it's really handy for those employees who may be required to complete a self-assessment. Now, P60s need to be given to anyone who is still in your employment as of the 5th of April. You can issue paper P60s or electronic P60s. Within the PayFit app, for example, P60s are issued electronically to employees once the employer's final payroll has been run for the tax year. One thing I would say is that if you do currently submit paper P60s, is that the HMRC are withdrawing paper stationery. So if your payroll software provider doesn't currently provide you with the functionality to submit electronic P60s, you may want to contact them to ask how they're going to be assisting you in future tax years. Now finally, in your end of year tasks is the submission of your P11Ds and your P11DB for any employees who've had benefits in kind. So P11Ds are submitted for every employee who has received a benefit in kind, and your P11DB is submitted to the HMRC to tell the HMRC how much Class 1A national insurance is due on both P11D benefits and any benefits that you have payrolled. Your P11Ds can be submitted electronically if your payroll software allows you to do this. There is also an expenses and benefits tool on the HMRC website if you want to use this, but you can also still submit your P11Ds on paper to the HMRC. And all submissions need to be with the HMRC by the 6th of July 2020. Remember that you only need to submit a P11D for benefits that have not been officially payrolled. If you have unofficially payrolled your benefits, for example, you aren't registered for the payrolling benefits service, but you have taxed your employees at source via the payroll, you'll still need to submit your P11Ds to the HMRC, but you'll need to mark these as payrolled. If you need to make any changes to a P11D that you've submitted, the HMRC requests that you do this using a paper P11D submission, even if the initial submission was done electronically. So now let's take a look at what you need to do to prepare for the start of the tax year. So the start of the tax year commences on the 6th of April, and most start of year tasks take effect from this date. So we're going to take a look at what this means for you. Firstly, if you no longer want to submit P11Ds, or you are looking to introduce employee benefits for the first time, then it is definitely worth investigating if payroll benefits would be of benefit to your organisation. So by registering for the payrolling benefits service, this will remove the need for most P11Ds for most benefits. The only P11Ds you would need to submit are for any employees who receive beneficial loans or any employees who you provide living accommodation for. For all of the benefits, this means that rather than submitting P11Ds at the end of each tax year, you would tax your employees each month through the payroll. Then this means that no further tax will be claimed by the HMRC at the end of the tax year. You have until the 5th of April 2020 to register, and you can't retrospectively do so. So if you do miss the date for registration, you will need to submit P11Ds for the April 2020 tax year. Now, if you have any Class 1A due on benefits in kind, you won't pay this to the HMRC each month, even if you payroll your benefits. You will still continue to submit the annual P11DB and make any payments for Class 1A national insurance by the 22nd of July following the end of the tax year. Now let's take a look at how you update your employee tax records. Your payroll software may do this for you, but if not, there are a few things that you'll need to make sure are in place for the 6th of April. Now, for the first time in a while, the standard tax code for the year hasn't changed, and this will remain as 1250L. You will also have to apply any P9 tax code changes that you receive from the HMRC. Now, not all employees are going to receive a P9. These are only for employees who are moving either back to or away from the standard tax code for the 2020 tax year. Finally, for updating your employee tax records, if any of your employees' tax codes end in an M1, a W1, or an X, this means they are currently on a month 1 or week 1 tax code. Now, because all employees need to start period 1 of the tax year on a cumulative tax code, it will be your responsibility to remove any M1, W1, or X from the employee's tax code ready for the period 1 payroll. Now we move on to updating your payroll software. Again, if your payroll software does this automatically, this is going to save you some time. If not, here is an overview of the main changes. The national minimum wage rates are increasing effective the 1st of April. There are also some changes to income tax rates and national insurance thresholds. Now, income tax rates and thresholds are not changing for Welsh taxpayers or rest of the UK taxpayers. Scottish tax rates are changing in line with the Scottish budget announcement back in February. However, these have been delayed to the 11th of May, so you won't be applying any increases to the Scottish tax rate effective the 6th of April this year. The HMRC confirmed this on the 17th of March. And they're also going to be releasing some guidance commencing the 30th of March on how to operate these, given that they're not starting from the start of the tax year. Statutory pay rates will also be increasing from the 6th of April. That includes statutory sick pay, statutory maternity, paternity, adoption, and shared parental pay. Now, the HMRC have now published all of the April 2020 rate changes, so it really would be helpful if you were to spend 10 or 15 minutes just familiarising yourself with these rate changes ahead of any potential employee queries you might have on April payday. Now, April 2020 is seeing the introduction of quite a few legislation changes, and that's just the ones that we've planned. So in the next section, we're going to look through some of the key legislation changes for April 2020. So the first thing that's changing is how the HMRC are going to govern national minimum wage compliance. So as well as the rate increases, the government are also introducing the removal of fines and sanctions for any national minimum wage breaches that are caused by salary sacrifice arrangements. Now, at first glance, this might suggest that employers are now going to be able to offer salary sacrifice, even if it reduces an employee below national minimum wage, but that isn't the case. You'll still be expected to top up any employees who fall beneath the minimum wage, but provided that you meet 5 conditions, the HMRC won't look to sanction or fine employers. Now, the 5 conditions themselves are quite detailed, and the links to them will be circulated after the webinar. But an example of one of these conditions is that if an employee falls below the national minimum wage because of a salary sacrifice arrangement, the employer won't be fined or sanctioned provided that they haven't previously breached national minimum wage regulations. Now, the HMRC are doing this to create quite a clear line between those employers who accidentally allow non-compliance and those who deliberately avoid their national minimum wage duties. The next and final change relating to national minimum wage is the reintroduction of the naming scheme, or the name and shame list as it's otherwise known. Now, this is the publication of the names of employers who have failed to meet their national minimum wage duties. The HMRC are also now going to give additional information on how these employers have breached their national minimum wage regulations. Initially, any employers whose minimum wage arrears were £100 or more would be published on this list, but that amount has increased to £500 or more. Now, to make sure that the HMRC are supporting employers as much as they can with national minimum wage regulations, they've created a new interactive guide to help employers in their national minimum wage duties. And again, we'll circulate the link to this at the end of the webinar. So next is the introduction of statutory bereavement leave. And this is a piece of legislation that we have heard of. It's been around for quite some time, but it's finally been implemented effective the 6th of April. And the government are estimating that it's going to help around 10,000 parents per year. So the idea of this legislation is to offer leave to all employees who suffer the bereavement of a child under the age of 18 or suffer a stillbirth after 24 weeks of pregnancy. This leave is also going to be offered to adoptive parents and those who foster. Now, unlike other types of leave, there is going to be some flexibility within statutory bereavement leave in that the employee can take 1 or 2 weeks, but if they take 2 weeks, they can take these non-consecutively, provided that they're taken within 56 weeks from the child's death. Statutory bereavement leave will be a day one right. Statutory bereavement pay will have similar eligibility conditions to the other types of leave that we have. For example, the employee will need 26 weeks of employment the week before the child's death, and the earnings in the relevant period must be no less than the lower earnings limit, which will be £120 for the April 2020 tax year. Now, just so you are aware, the statutory bereavement leave will not replace statutory maternity leave. So if the employee suffers a bereavement but has qualified for statutory maternity leave prior to this, they are still able to take their maternity leave if they wish to do so. The next change we have is to the employment allowance, and there are two main changes relating to the employment allowance from the 6th of April. The first is that it's increasing from £3,000 to £4,000. And the next change is that it will now only be available to employers who paid less than £100,000 of employer national insurance in the last tax year. In addition to this, if you are an employer who currently claims state aid, you're going to have to factor in how much employment allowance you are claiming, as this will go towards the total amount of state aid that you can claim. If you do claim state aid, there will be some additional fields on the employer payment summary that you will need to be mindful of, and you will need to be sure you have updated in your payroll software. So you will need to indicate whether or not state aid does apply. And if it does, you'll have to indicate what sector your company is in. And finally, there will be a field to show how much employment allowance and state aid has been claimed in the current and previous 2 tax years, and this figure will be in euros. So the final change we're going to talk about is the IR35 legislation, or the expansion of the intermediary regulations into the private sector. And I say expansion because these regulations are currently active in the public sector. So as I've already mentioned, that the regulations are now being postponed until April 2021. For some employers, I'm sure this will be welcomed because it's going to give you the opportunity to have a little bit extra time to prepare for the changes. But for some employers, I imagine that there will have been a lot of time and resource that have already gone into making sure that their preparations were ready and processes were in place for the 6th of April. So what is the IR35, or the intermediary regulations? The HMRC are wanting to take control over the tax avoidance issue amongst those individuals who use an intermediary to provide works and services to businesses. But from April 2020, it's going to be April 2021, it's going to be the responsibility of medium and large organisations to determine whether a worker is inside or outside of IR35 regulations. And this will determine whether or not they will have their tax and national insurance deducted via the payroll. So what is the actual problem? So if we look at the tax avoidance report that the HMRC issued relating to the 17-18 tax year, the HMRC had a difference of £7.4 billion in what they received to what they expected to receive from self-assessment tax. So from here, it's quite easy to understand why the HMRC are wanting to make changes to the intermediary regulations. So at the moment, if workers continue using an intermediary, they are benefiting from allowances for the likes of expenses and tax, and they are also potentially paying lower rates of national insurance and income tax. As well as this, fee payers, or the people that are responsible for paying the worker for their work completed, are not currently having to pay any employer national insurance. They're not currently having to factor in the worker's payment in the apprenticeship levy calculation, and they're not having to provide a workplace pension, annual leave or other employment rights because the worker is not deemed as an employee. So from April 2021, workers are going to need to be assessed by the client they are providing the works for before any works start. Now, if the worker is deemed to be within the IR35 regulations, they are going to have their income tax and national insurance, now this is employee and employer national insurance, deducted directly from their payment for services and paid to the HMRC. In addition to this, they'll be reported on a full payment submission each time the worker is paid. The payment will need to be included in the apprenticeship levy calculation. And these payroll tasks are going to become the responsibility of the fee payer, and the fee payer is the person that is paying the intermediary for the work carried out. Now let's take a quick look at the IR35 supply chain, and we're going to focus primarily on the client and the fee payer for two reasons. Firstly, because the client and the fee payer could be one in the same entity, so it is possible for your organisation to be both. And secondly, it is the client and the fee payer who are most likely to be impacted from a work and resource perspective with the introduction of the IR35 regulations. So the first thing that the client needs to do, and remember the client is the person who is receiving the works or services, is carry out an individual status determination before work starts. And what this means is that the client is going to have to look at that individual by themselves, so they can't make any blanket decisions on all of the intermediaries that they work with, and look at the contract to see how the relationship is going to be set up. So for example, they're going to have to consider who provides the equipment for the worker to carry out their role, who dictates to the worker how many hours they work and how many days they work. And from here, they're going to have to make a determination as to whether or not IR35 regulations apply. They then need to keep detailed records of the determination, because the status determination needs to be passed down to the fee payer and the worker. Now, if you are the client, you need to remember that until you pass that status determination down the chain, it will be your responsibility for the deduction of income tax and the likes of employee and employer national insurance. Now, when that status determination is passed down the supply chain, the worker and the fee payer have the opportunity to challenge the status determination if they disagree. They need to provide the client with reasoning behind why they feel they disagree. And from here, the client has 45 days to respond to the determination dispute, giving careful consideration to the reasons that they have been provided with. Now, until the dispute has been resolved, the initial status determination will apply. Again, if you are the client, it is important to remember that if you do not respond to the dispute within 45 days, again, the responsibility of deducting the income tax and the national insurance will then remain with the client. So once the status determination has been agreed, the fee payer is responsible for calculating the deemed payment for the worker. deducting the income tax and employee national insurance, deducting the employer national insurance, reporting the worker on the FPS, and including the worker's payment in the apprenticeship levy calculation. So the worker who is within IR35 is a deemed employee for tax purposes, but this doesn't necessarily mean that they are a true employee. So this means that they're not going to have any entitlement to annual leave or workplace pension and company benefits, and they're not going to have any entitlement to statutory leave and pay. So how can you prepare for the IR35 changes? Aside from the fact that we now have an additional 12 months to prepare, there are some things that you can do to understand what your role is within the IR35 supply chain and make sure that you have really strong processes in place. So firstly, if you familiarise yourself with the tools that you'll use to make the status determination. So the HMRC have a tool called the CEST tool, which is the Check Employment Status tool. This will allow you to determine whether or not the the worker is within or outside of IR35 regulations. If you already have individuals working for you via an intermediary, these will also need to be assessed by you when the legislation does come into effect from the 6th of April 2021. But remember that you'll only assess them for works carried out on or after the 6th of April 2021. It will also be worth contacting current individuals who work through an intermediary to make them aware of the changes. You may have already made them aware that you are making changes based on the legislation going live on the 6th of April 2020, but you may need to communicate with them now that this is now changing. If you are a fee payer, you will need to decide whether or not your workers who fall inside IR35 regulations will be included on your regular payroll, or whether you will set them up on a new payroll. If you want to set them up on a new payroll, you will need to request a new pay-as-you-earn reference number from the HMRC. Next, it'll be important to understand how your payroll software deals with IR35 workers. So check with your payroll software to make sure that they are set up to make the appropriate deductions for those who fall inside of IR35. For example, whilst IR35 workers will be taxed and subject to national insurance through the payroll, they won't have their student loan deducted. So it's important to understand that your payroll software can cope with these requirements. And finally, understand the financial impact on your business. So for those workers that fall within IR35 regulations, you may see an increase to costs because of the employer national insurance and apprenticeship levy that you may then be subject to pay. So that brings us to the end of our slides. I'd like to say a huge thank you for everyone who has attended the webinar today during what has been one of the most hectic tax years. I'm sure many of you will have seen in some time. So we'll now move on to any questions. So we have 3 questions. So the first question is from Asif. Yes, it was true that the IR35 regulations were going to take effect from April 2020. However, as of yesterday, it has been announced that the changes will now take effect from April 2021, and the government have said this is a knock-on impact of the coronavirus. The next question is, do you think that the delay in implementing IR35 will mean that further changes will be made to the legislation before April 2021? So it would be very difficult to say at this stage whether or not they would make any changes to the legislation. However, I wouldn't expect any changes to be made simply due to the fact that the current legislation for IR35 in the private sector will mirror that of what is already implemented in the public sector. So if we were to change anything in the private sector, that would potentially have a knock-on impact with the public sector. But again, if you are impacted by the IR35 regulations, I would keep an eye out on the HMRC website for any further information. Next, there was a question from Kashmira. Has the HMRC announced the IR35 delay? It's not showing on their updates as of yet. I don't believe it has been published on the HMRC website yet. It has been reported by other sources, and I'm sure there'll be no issue with us sharing those with you at the end of the webinar. But again, it's not on the HMRC website as of yet. We have a question from Stephen Sanderson. Does PayFit software automatically deal with the updates required at the start of the new tax year? Yes, we do. So there were two parts to the update at the start of the tax year. The first is the changes to the employee tax records, where we uplift tax codes or remove any month one from the end of the employee's tax code. We do that on the employer's behalf, and for any changes to rates such as national minimum wage, statutory sick pay, maternity pay, etc., we automatically uplift that for employers. Next, there was a question from an anonymous attendee. How does PayFit handle the COVID-19 updates from HMRC? So there were two aspects to this. One is how we handle them in-app. We have now coded within the app the functionality for employers to record any sickness related to the coronavirus, which will then automatically kickstart the day one SSP regulations. Now, the HMRC haven't yet confirmed how reclaiming statutory sick pay will be done by smaller employees. However, at the moment, our aim is to at least provide employers with a report so they can at least let the HMRC know how much they are wanting to reclaim. Next is a question from Flavia on, can an employee on maternity pay have the choice of claiming statutory maternity pay or statutory bereavement leave? So I think the answer to this question is entirely dependent on the circumstances. So given that one of the reasons for implementing statutory bereavement leave is for any stillbirths after 24 weeks of pregnancy, statutory maternity leave should still apply from this date, because there is a mandatory 2-week period that statutory maternity leave and pay must be given to the employee after they have given birth. After that 2-week mandatory period, I would say that yes, it is up to the employee whether or not they wish to remain on maternity leave or whether they wish to use their statutory bereavement leave. Next is a question from Natisha. Do we still need to provide key information documents from April 2020? I'm assuming this is in relation to the IR35 regulations, but let me know if I've misinterpreted that. So there hasn't really been any guidance issued in terms of what we should and shouldn't be saying to anybody who is impacted by the IR35 regulations. This, I suppose, will depend on what you have already communicated. So if you have already proactively communicated what you will be doing for those intermediaries impacted by IR35, then I would recommend a communication to go out. But in terms of what the HMRC have recommended, again, they haven't published anything yet. So we wait to see what they say before we work out what the next steps are in providing documentation for April 2020. Okay, we have another question. If we have one employee only, do we need to complete IR35? So IR35 regulations are for those large or medium organisations. So there are a couple of different things that you need to consider. There are 3 criteria, and out of the 3 criteria, you need to meet 2. One of the criteria for IR35 regulations to be applicable to you is that the employer will have 250 employees or more. So if you only have one employee, it is unlikely, but we will provide you with the full criteria for IR35 at the end of the webinar. Okay. We don't have any more questions, but I will still hold on for a couple of minutes in case anybody thinks of any questions that they would like me to answer. Okay, we don't seem to have any more questions coming through now, but the slides will be circulated to all attendees, and the webinar has been recorded for those who haven't been able to attend. If you do have any questions, please feel free to contact us. If you have any questions about how certain aspects of the legislation work in the PayFit app, please feel free to contact us or book a demo. But thank you very much for attending today. Thank you.